The data turns out to be uneven. We look to the future and we must be vigilant about inflation risks, the Reserve Bank of Australia's governor said today. As a matter of fact, Michelle Bullock's comments could equally well be used by the governors of other major central banks in their forecast for future interest rates. The Australian regulator maintained its key interest rate today unchanged at 4.35% for the fourth time straight. It was a completely expected decision. The traditionally evasive answers from Japan's Ministry of Finance did not come as a surprise. Its officials refrained from commenting on whether the agency was involved in selling the US dollar. Deputy Finance Minister Masato Kanda reiterated on Tuesday that the government would continue to maintain the same firm approach to the yen's erratic movements. Despite regular warnings against high volatility in the dollar-yen pair, the yen remains attractive to carry trades. In such transactions, investors borrow in low-yielding currencies to invest in high-yielding assets elsewhere. In this regard, the greenback is alright. After all, it provides a high rate on short-term deposits among G10 countries. In the future, the Bank of Japan will be very cautious in monetary tightening. Besides, monetary easing by the Federal Reserve will still take some time. Therefore, even after last week's advance, the yen remains the most undervalued currency in the G10 group. The dollar-yen pair again is looking very volatile today, trading downwards in a wide range of 153.80 to 154.70. But the US dollar itself is still greatly overvalued. Recent comments from the Fed's policymakers even not heated up the greenback, but at least brought it to a stable state. The US dollar index, which measures the greenback's trades in relation to its six rival currencies, is trading today within an intraday corridor between 105.00 and 105.30. After Jerome Powell outlined the central bank's intention to cut interest rates, even despite fading inflation, the words of the New York Fed governor sounded with a hawkish tone. So, John Williams said on Monday that decisions on interest rate cuts would be made based on incoming economic data. So the policymaker made it clear that such policy moves are not expected in the near future. Meanwhile, his Richmond Fed colleague Thomas Parkin expressed confidence that inflation would reach 2% once the effect of high interest rates are fully realized. He also warned of persistent price pressures in the housing and services sectors. That the risk of inflation in the United States still persists and that this keeps the US dollar from a sharp fall. At the same time, US stock indexes began to grow. After closing higher yesterday, Wall Street continued to show optimism today, and the S&P 500 index rose by 1%. It's still trading in the green today within an intraday corridor of 5,142 to 5,181 points. Amid the empty economic calendar this week, market sentiment will be influenced by the decisions of the central banks of Great Britain, Australia and Sweden, as well as statements by the representatives. The polls are expected to maintain the upward momentum after last week's successful run. Commonly, risk sentiment, which drives Wall Street stocks higher, also acts as a driver for the European currency. However, like the US and the EU economic calendar today contains several major reports. For example, data on the trade balance of Germany, which came out at 22.3 billion euros. Moreover, this indicator looked prophesied that exports exceeded imports. At the same time, factory orders in the world's third largest economy dropped by 0.4%. If we exclude large-scale options, then the number of new orders in German industry, on the contrary, inched up by 0.1%, and the report on retail sales in the Eurozone was also trending. That's the indicators grew from a minus 0.6 to minus 0.5% from a year ago. At the same time, the rate of decline in retail sales in the euro area was expected to slow down the fall to minus 0.3%. Besides, retail sales jumped by 0.8% month-on-month in March from February. The figure was ahead of the consensus at 0.6%, and it was the sharpest increase in retail activity since September 2022. It's consistent with the other fresh economic data that show some economic improvement in the bloc of European countries. For this reason, the single European currency perked up today, and the euro-dollar pair is trading higher in the intraday corridor between 1.0758 and 1.0785. Currently, Europe is preparing for events dedicated to the end of World War II. For example, in France, the day off begins tomorrow, so the currency market is trading vigorously today in the early New York session. The European currency did not miss its chance. On the whole, the euro is still having a pullback from the resistance level of 1.2800. To consolidate bullish positions, the instrument has to settle above this critical line. Otherwise, the euro may resume its fall, especially if the price stays below 1.0750. For oil prices, the key sign of growth is still political news from the Middle East. As concerns about potential disruptions in crude oil supplies from the region grow, so do oil prices. Today, the benchmark Brent is trading below its usual range of $83 and $84 a barrel, where it has been stuck for the past few days. Considering the complete absence of any news that could affect prices, the US dollar has the greatest influence now. The data on the US oil inventories is published today, which should decrease by 1.4 million barrels. Apparently, this will lead to some increase in oil quotes, so prices could rise above $84 per barrel. As for forecast for OPEC plants, most analysts believe that the cartel and its allies will maintain the output cuts, perhaps even right into the second half of the year, and this should support high oil prices in the future. You have watched the market review by InstaForex analyst for Tuesday, May 7. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments down below. So see you online tomorrow.